Recent events have shown that in order to ensure your capital is performing to its fullest potential, it is important to invest in a diverse range of assets. If you have previously considered investing into private limited companies, but have been put off by the less than transparent process, I am here to guide you through some of the key topics. Hi, my name is Ragavan Arunachalam, and I'm a senior associate in the corporate and commercial team of Collyer, Bristow. These are my top 5 tips for making a successful private equity investment. Tip 1, know your target. Forgive me for repeating the basics, but a successful exit starts with a successful entry. Before deciding whether to invest, you need to clearly assess the target company against your investment criteria. Having clear criteria is critical to a good outcome. An important driver in your decision-making process will be whether the deal is based on solid financial data, which align with your key benchmarks. For example, if you're looking at an exit where you achieve a multiple of 3 times the money you put in, you need to ensure that the base case model over your investment period supports this. You would also be prudent to ensure that your worst case model results in at least a break-even position. It is important to thoroughly test the information you're being given and parse the data for anomalies. If your best case is based on an extrapolation of the best year the target has ever had, you're going to come unstuck when there's the inevitable regression to the mean. To get an accurate grip on the prospects of a target, you will obviously need assistance from your financial advisors. But this financial due diligence will need to be supplemented by commercial due diligence. Commercial due diligence is important, especially if you do not yourself have specific knowledge of the market in which the target operates. Understanding the context of the target is key to understanding the likely strengths, weaknesses, opportunities, and dangers that the target will face. The best investments are likely to be those where you identify prior to your investment really simple ways to accelerate the growth of the target. Key to your investment plan should be a strong management team. A strong MD with a clear vision of the best way to implement the agreed business plan, and a prudent FD who has a grip on the financial detail of the business. It is of paramount importance that you're completely comfortable with the team charged with delivering growth. I am a firm believer in people buying into people, and you need to be able to look the management team in the eye and have complete trust and belief that they will deliver on their promises. If you don't believe in the team, you should not be investing in the target. If the numbers check out, you have transparency on the easy wins available to drive the growth of the target, and a strong management team. The next step is ensuring the legal foundation of the target's business is strong. If possible, performing comprehensive legal due diligence of the target's business will save you a lot of headaches further down the line. If the target is IP rich, a comprehensive review of the IP owned, for example, ensuring it owns the IP it purports to own and ensuring it is not infringing the rights of any third parties, is critical to a successful investment. You do not want to buy into a target on the basis it can generate revenue from certain assets, only to find out it does not own good title to said assets. The same goes for a myriad of other legal topics. For example, if you don't want to invest into a target if there's serious litigation pending, or if key customers can simply walk away, or there have been numerous breaches of employment law. In essence, you need to ensure that A, the target has the assets it needs to fulfill the business plan, and B, there are not any legal issues which will distract the target from making good on the business plan. When analysing the impact of this, it is important to get a clear steer from your advisors as to the importance of any issues identified during due diligence. Good advisors will share the burden of deciding what is and what isn't a red flag. Tip 2. Make sure the acquisition of the target, your investment, is suitably documented. The mechanics of protection available to you will depend on the structure of the investment. However, something which ought to be always available is suitable warranties. Warranties are statements as to the state of the target, which, if proven to be inaccurate, can result in a claim for damages. Warranties are the natural extension of, and should be informed by, the legal due diligence you have conducted. By including carefully worded warranties in the investment documentation, you are putting your understanding of the asset you are purchasing on a contractual footing. For example, if as part of the investment documents, the investor obtains a warranty that there is no material litigation pending against the target, and subsequently it transpires there is litigation which the target loses, then the investor may be able to claim for the damages they have suffered. That is to say, the diminution in value of the target pursuant to losing the litigation. A more targeted way to contractually supplement the due diligence you have conducted is to seek specific indemnification against specific issues. An indemnity is essentially a promise to be made good on a loss you have suffered. During negotiations, indemnities are usually resisted by the party being asked to give them. This is because usually indemnities are easier to enforce with more wide-ranging recovery. However, if during the legal due diligence process you have identified specific problems with the target, for example, the target has consistently breached data protection law in the way it holds and processes the data of customers, your best bet as an investor is to obtain a specific indemnity. Price adjustment mechanics are also a good way to de-risk your investment. We have briefly touched upon one way to adjust the price you have paid, namely pursuing a warranty claim, but the downside to pursuing a warranty claim is that litigation is both expensive and uncertain. There are other better ways to ensure that you're paying an appropriate price for the asset you are acquiring. For example, if you carefully construct the consideration payable by reference to the future financial performance of the target, then you're more likely to be able to ensure you're paying an amount commensurate with the value of the target. Similarly, if your valuation is based on historical performance or the current asset base of the target, there are mechanics, such as having completion or locked box accounts, which can assist with the recovery of consideration if the financial reality of the target is not quite the rosy picture painted by the management team. Other ways to protect your investment include inserting appropriate restricted covenants into the investment documents. If you're investing into a target on the basis of a carefully vetted management team, you really want to disincentivize them from pursuing projects which might conflict with the business interests of the target. As such, it is standard practice to bind relevant individuals into covenants, which prevent them competing with the target for a reasonable period of time. What has been discussed up until now is just a few ways you can de-risk the acquisition of the asset. For further guidance on this topic, please do get in touch. Tip 3. Make sure the relationship between shareholders is appropriately documented. The advice here really depends on the structure of your investment. The recommendations for an investor acquiring the entire issued share capital of a target via a special purpose vehicle versus an investor taking a majority stake usually over 50%, or an investor taking a minority stake, usually under 25%, will differ. For example, if you're an investor facilitating a management buyout, leveraged or otherwise, then you might be keen to ensure the management team are appropriately incentivized by well-drafted good and bad lever provisions. If part of the business plan is to align the interests of management with the continued growth of the target, you need to reward behaviors which contribute to that growth and disincentivize behaviors that do not. The main way to do this is to allot and issue shares to management, such that as the target grows in value, so do their shares, to motivate management to stay with the target and on track with the business plan. You might also insert good and bad lever provisions. These provisions essentially penalize individuals who leave or otherwise underperform by, for example, reducing the economic value of their shares to nil, and reward those who stay and help grow the target by protecting the value in the shares they have. This is a simplification about how good and bad lever can work, but the key takeaway should be that if you give shares to management, make sure this as an incentivization is properly structured. Another area of concern will be preemption rights, both on transfer of existing share capital and the issue of new share capital. All investors will be keen to ensure ownership of shares is tightly controlled. One way to do this is to have preemption rights on the transfer of shares. These rights ensure that existing shareholders have the right to purchase shares from their fellow shareholders prior to such shares being offered to third parties. This provision is aimed at ensuring that share capital is kept within a defined body of individuals. This is important as investments in private limited companies are built upon the relationships between management and the equity funders. As such, entry into the share capital pool needs to be tightly controlled, such that the shareholders as a group remain harmonious. Equally important, especially if the investor is taking a minority position, will be ensuring that the value of their shareholding cannot be manipulated by the issue of new shares or similar. This can be protected in several ways. There could be preemption rights on the issue of new shares, which give all shareholders the ability to participate pro rata in future fundraisers. There could be anti-dilution protection, which would increase an investor's shareholding at little or no cost to them to prevent any dilution of their percentage shareholding. Or simply there could be a right of veto on the issue of new share capital without the investor's consent. If there's a majority and minority shareholder, the majority shareholder might wish to insert drag-along provisions into the company's articles of association to ensure that, should they wish to sell the company in the future, the process cannot be stymied by a reluctant minority. Often a third-party buyer will want to ensure that it can purchase 100% of the issued share capital. A drag-along provision ensures that if the majority shareholder found a buyer for their shares, then they could drag along the minority shareholder with the proposed sale, usually on the same terms and for the same price per share. This would potentially make it much more likely that the majority shareholder would be able to realize the value in its shares. The corollary of this provision is tag-along. This applies where a minority shareholder is anxious that the majority shareholder might sell their stake to a third party without ensuring the minority can exit too. To avoid being left with a new majority shareholder with whom they do not have a good working relationship, tag-along rights would step in, ensuring that the majority shareholder could not sell without the minority shareholder being able to sell their shares on the same terms. In addition to what we have already discussed, topics such as investor consent rights, i.e. the ability for investors to veto material commercial decisions, information rights, to allow investors to monitor the financial performance of the target, and board control are all key to ensuring that once deployed, the investor's capital is appropriately protected. Tip 4. Carry out post-acquisition review of target. Implement your strategy to improve performance. Easy wins. Go after low-hanging fruit first. As discussed, the most successful investments are likely to be those where prior to investment, you can see the steps that need to be taken to accelerate growth. Depending on the financial and commercial due diligence, and indeed your own experience of the context of the target, it's always best to invest into businesses you understand. You have hopefully identified what areas of the target's operation can be improved. Make sure you prioritize implementing those easy wins as soon as possible. Ensure you have an action plan for those areas of the target's business that were identified by your legal due diligence as being suboptimal. Now you have invested in the business, the last thing you want is for your plan for growth to be derailed by, for example, easily avoided litigation. It may also be prudent to do a post-acquisition review of those areas of the business which were not deemed critical for the pre-acquisition due diligence. It may be that the investment was carried out at pace. With time to reflect after the investment and greater access to the workings of the target, it may be easier to do a deeper dive into areas that could be improved. Tip 5. Ensure a smooth exit by having stuck to tips 1 to 4. If you appropriately due diligence the target, you increase the likelihood you'll be investing in a good opportunity. If you document the investment with care, you will mitigate the risk you'll be left out of pocket. If you plan how to deal with your fellow shareholders, you will reduce the likelihood of disagreements by making clear everyone's expectations. If you implement a well thought out business plan, you will grow the value of the target. By assiduously sticking to the aforementioned tips, you will be able to crystallize the value of the investment in accordance with the benchmarks you've previously set yourself. A smooth exit is far more likely to be achieved if you've clearly mapped the pathway to it from the beginning. My name is Ragavan Arunachalam, and these have been my top 5 tips for a successful private equity investment. Thank you for listening, and please do not hesitate to get in touch with Collyer Bristow if you have any questions or require assistance in this area.